Let's get across the market open now with Zach Rias from Banyan Tree Group joining me now. Zach, great to have you in the studio. So we saw some choppy trading on Wall Street overnight. What was behind that?
Yeah, look, it's interesting. I think a few of the macro data points out of the US have started to touch on the soft side. And I think what's the market is now concerned about is if you look at some of the movements in the sectors, yields have declined, but some of the duration stocks like tech haven't really rallied on the back of that. And you've seen stocks like sectors like consumer staples, healthcare get a bit of a bid. And I think what that shows to us is growth concerns starting to creep in the market for a country, obviously US, a region which has been a bright spot in the global macro. And I think that's now the concern maybe shifting a little bit. If you look at how the sectors have performed over the last 3-4 days in trading, obviously we had the weakness last Friday, but it seems like maybe the shift is going from inflation concerns to a bit more growth concern in the US. And that for the broader macro piece is should be a bit concerning. And added to that, I think what's really probably added a little bit more motivation for short-term traders is what's Department of Government Agency doing in the US. They've really started, we've seen that email from Elon Musk saying, justify in a dot point why you should be hired. And from my understanding, about 3% of the federal government agency workers have taken an early or a redundancy packet of sorts. So things are moving on that front. And now traders are starting to feel like, well, this may not be an inflation issue. This may start becoming a growth concern. And so that's what you're seeing. The other big point is for investors to watch out is obviously Nvidia results coming out on Wednesday night. That could give, I think it's a double-edged sword, frankly. It could give the bears a little bit more motivation to drag the tech sector much lower. It's interesting, there was news out of Microsoft that they have pulled back on some of the leases on their data centers. And so, again, market will read, it could very easily be just Microsoft saying, look, we don't want to go into these particular jurisdictions or regions, we'll pull back. Market tends to read a lot. But nonetheless, it is interesting that they are pulling back on some of their sites. And again, so the Nvidia earnings could be very interesting. And the final point I will say, just to back up, obviously, that there may be a shift in narrative in the market from inflation to growth concern is that the results for fourth quarter earnings have been really good in the US. In fact, I think they're coming in at about 12.3% versus market expectations of 8%. But it's the outlook, the margins outlook that's concerning people. And so despite healthy earnings, stocks haven't really caught a bid. And so that buy the dip hasn't really worked. So that's the narrative that we've been seeing in the last couple of few trading sessions.
We've just seen in the last hour President Trump say that he's going to push forward with those plans for tariffs on Canada and Mexico. Will that provide any certainty for the market?
Yes and no, to be honest. Interestingly, I was actually looking at a chart when Donald Trump last introduced his tariffs in 2018. And as the duties went up for the US for imports, interestingly, inflation actually tended lower. Now, I know we're not in 2018. There's a lot more other things happening that weren't happening back in 2018. But look, I think if the concern is inflation, that and a lot of people are suggesting that will bring in inflation, higher tariffs and whatnot. On the back of that news, currencies didn't move too much, actually. Both the Canadian, I think, and the Mexican peso didn't move too much. They've already taken a bit of a hit anyway. But yeah, so I think the market is still kind of seeing how it all plans out. But if they do get introduced, this whole notion around how it could be inflationary, 2018 experience shows that it was actually, inflation actually trended lower after the initial concerns. And that again is good for bond yields, obviously, and that's again good for cost of capital. And good for equities, depending on how it all plays out. But yeah, so look, I still think a lot needs to go under the bridge, and I think markets in general are just getting used to it. And I think this is something we said before as well. And my final point on this is that when we talk to companies, when we listen to companies' earnings calls, and when we see management talk, a lot of management teams are already well prepared for this. They're well prepared for tariffs from 1.0, obviously in 2018, but they're also very well prepared from a supply chain perspective because of the experience in COVID. So you may be surprised on the upside, which is why, back to you, I guess the point that you're probably making is that I think the markets are kind of just taking it in their stride now.
Okay, well, let's focus on Europe now. And we did have the Germany's election yesterday. How did that shift markets?
Yeah, look, honestly, from our perspective, we haven't paid too close attention of Germany's election per se. But one thing I will suggest is obviously the incumbent governments around the world are kind of being shifted out. You've seen that in France, you see that in Canada. And so, look, any sort of political uncertainty is not good for markets. But if you just bring it back to economic growth, if you look at the GDP growth for last full quarter, and it's the chart on your screen, you can see Germany's really struggled. And so what's happening on the election front is very much in line what's being permeated in the economic front as well. And so that's a concern. And look, there's a broader reading on Europe there. You see Italy, France, Germany, broader euro area barely eked out a growth in fourth quarter 2024 year on year. So look, from our perspective, Germany is really struggling, both from structural issues, but also from geopolitical issues. You've seen what's happening with Russia and US having, basically talks about what effectively happens, which has a meaningful implication for Europe, without them having any seat at the table. I mean, forget about Europe. Even Ukraine doesn't appear to have a seat at the table. So the point is, we're very cautious because of charts like that around Germany and broader Europe. But back to my earlier point, if US starts to wobble, which is, you saw in that chart, US and Japan were the leading kind of bright spots. If they start to wobble, we've got concerns. But yeah, overall, we're very cautious of German equities. Interestingly, German equities have an absolute rally over the last 6 months to 1 year. It's up to 25%. And growth doesn't suggest that's justified, but it could be just valuation, or it could be just people kind of forward-looking potential turnaround. So yeah, we're cautious of broader Europe and Germany.
All right, well, coming back home now, what are some of the Aussie stocks that are on your radar? Yeah,
look, as we kind of filter through the reporting season, some stocks that we've been following for a long time, some stocks that we're already invested in are looking pretty interesting to us. So I just want to call out 3 interesting ideas. First one is, I think, Charter Hall, which is basically Charter Hall social infrastructure. And that's all basically childcare centres and anything kind of social infrastructure around life sciences and whatnot. And look, we've been very positive on this stock for a while, and it's been a bit of a up and down. It's had a really good share price rally just recently. The recent results, a couple of things just we really liked about it. First, earnings growth around rent reviews were much more positive than the market was expecting. There was a fair bit of negativity going into this stock heading into the result. So that's number one. Rent reviews, they've got about 43% rent reviews, market rent reviews happening over the next 4 years. And that could really help alleviate some of that concerns around income growth. It's not thumping the table kind of income growth acceleration, but it's better than what market is expecting. Second, they've just announced a $25 million buyback, which is great. And they've also ticked up the distribution from 15 cents to 15.3 cents. I know that doesn't sound much, but for a REIT, 2-3% uplift in distribution is not bad when you're paying 5.5% yield. And so Charter Hall is one we like. The other one that we like, we actually just upgraded as well, is Northern Star Resources. Look, this is a well-known gold stock in Australia. It's probably our pick of the, it is our pick of the gold miners within Australia. Look, first and foremost, from a macro point, we still expect gold price to go up to 3,000 and above 3,000. We think there's just structural drivers driving that. And then also these guys have a very attractive production growth outlook. And they've really actually, over the last 3 or 4 years, and it's a 5-year plan that they will progress into, they're making hay while the sun shines, as someone put it to me. And that's like they're focused on costs. So they've really improved their return on capital invested. They're focused on production growth. So getting good tier one assets that they can see good visible production growth, and then they've got a really healthy share, in a gold price environment. That really ticks everything, along with a very strong balance sheet, which allows them to do extra capital management. So they've got share buybacks there. Their current share buyback is almost done. They were a little bit cagey on whether they'll extend it, but they have a very strong history. So Northern Star, we get a price target of $19 something. It's about 12% upside, but this is the one that we would definitely play as a pure play. And then finally, IPH. Trading on 10, and look, that chart looks nasty. I understand that. But look, I think the just challenging conditions that these guys have felt. Remember, they were a target of a cyber attack as well some time ago. But they've had challenging conditions in their end markets. But there are some green shoots starting to happen. Trading on 10 times PE, forward PE, yield of 7.3%. Some of the green shoots are patent filings. So IPH is a bunch of lawyers who do patent filings across the world. Asia, Australia, and Canada, they've got market-leading positions. So patent filings in Asia is starting to run at a decent clip of 10% in the first half, and that momentum has carried into the second half. So we expect that to improve. They still have a decent position in Australia. Filings were a little bit weak, but they still managed to produce a positive earnings growth. And Canada, which has been a bit of a soft spot, or sore spot, is starting to turn around as well with some of the issues they've had. So 10 times PE, 7.3% dividend yield, which is, I think, starting to become, which is partially franked as well. It looks really attractive to us from a risk reward perspective.